So today we have Michael Mortimer from NS Partners joining us. Mike, welcome, and how are you?
Hey, Neil, thank you very much. Thanks very much for having me on. So it's a pleasure to be here.
Brilliant. We are very happy to have you here. Mike, so we'll hand over to you for about 15 minutes of presentation, and then we'll hopefully be able to take some questions afterwards.
Okay, perfect. Thanks very much.
Brilliant. Thank you.
Okay, so jumping straight in, thanks very much for having me on today. So it's been an interesting quarter, obviously. We've gone from Q1, obviously fears of rampant inflation, exacerbated by the war in Ukraine. So now I think if you can characterize the next quarter, I think we can probably talk a little bit about, well, markets have been focused about the risk of central banks around the world potentially removing too much liquidity from markets into an oncoming slowdown economically. And that really caps off what has been for global markets the worst first half since the Great Depression. So I can leave that one with you. So it's sorry to start on a bit of a gloomy note, but at the same time, we've seen emerging markets actually outperform developed markets. So, you know, usually we characterize it as EM usually comes into these sorts of slowdowns having the biggest party, and they'll have the biggest hangover in this sort of situation, whereas it's actually slightly outperforming. So we can dig into the reasons for that a little bit later on. So now just moving along to a bit of a quick firm update here. So over the quarter, we've actually had some positive inflows. And so, you know, for us, it's actually a little bit of a surprise, to be honest, given the sort of market sentiment. But I think it means that allocators, you know, EM is obviously under-owned. It's a bit unloved, and we're seeing some fresh allocations from people from some institutions that are allocating to EM for the first time. So it's quite exciting, along with taking some share as well. And so just on the personnel, obviously me there, so I've come on board to help with the content generation. So you might have seen some emails come out from me on monthly updates. And then so obviously there'll be some more to come, and I'm going to be helping to sort of build out a CRM system. We can manage data and sort of pinpoint where flows are coming from, and just have a little bit more of clarity in terms of how the business is looking, along with sort of building out that content. So jumping into what we call the cutout and keep slide, which gives you a nice sort of broad summary of what's been going on in the quarter. So if we start at the top in terms of what worked, so last quarter actually, commodities and energy and basically cheap stocks did very well in a rising price environment. So we've actually seen that reverse. And so there were discussions last quarter about whether or not that we should be increasing exposure to those sorts of areas. But our liquidity and macro analysis, as Neil mentioned before, suggested that we're moving into an economic slowdown where some of the stocks in these sectors are actually going to be quite vulnerable. And we've seen a little bit of that come through this quarter. And so we've actually done well being underweight Brazil, South Africa, and also being underweight consumer cyclical technology stocks in Korea and Taiwan. But what also worked was within materials. So we've got selective exposure to lithium names in China and in Chile. So those names did quite well through the quarter as well. In terms of what didn't work, so we've been talking a lot about China lately and what we're seeing on the ground in terms of a recovery in liquidity that we're seeing come through, a recovery in some of the macro data that we're seeing as well, and also easing regulatory headwinds on a number of sectors, including technology. So why are we still underweight? Well, we're going to move gradually and adjust our forecasts as the data comes in. And then what we're focused on is if we're happy, we're happy with the sort of progress in that liquidity and macro data that's coming through, we then need to find the stocks, make sure we have the right stocks. So we're happy to sort of toggle that out gradually as that data comes in. So we can dig in a little bit more to Taiwan and Korea as we work through the presentation. The other mention would be what didn't work was consumer discretionary. So you're seeing a big bump in those Chinese mega cap tech stocks, which are classified as consumer discretionary. So they basically a lot of it's to do with Meituan in that sector. So if we just quickly run through sort of the bad and the good in respect of single stocks, got Castle there, so contemporary Amperex Tech, struggling to pass through cost price rises. So we've actually sold that from the portfolio. India Builders Real Estate, it's going through a merger at the moment. The market is not too hot on it, but overall the real estate theme, the housing theme in India is something that we can dig into a little bit later on. Now, Wizz Air, everyone's been hearing about all the sort of drama that's going on at Heathrow Airport. Airlines are really struggling to keep up with the demand boom at the moment. Raging demand for leisure travel at the moment, and Wizz Air is really struggling to scale up capacity, and investors are also a little bit worried about oil as well. So that stock is under review at the moment. We're going to sort of test and see whether that investment thesis still holds up. So in terms of the good, Longy Green Energy is a big structural winner in our eyes. It's benefiting from rising oil prices, so it's a renewable play. Varun Beverages, we can dig into that a little bit later. Very high quality Pepsi bottler in South Africa, and Shanghai Baosite Software. It's automation within the steel industry, and so as the economy sort of rebounds out of lockdown in China, it's going to do very well. And so in terms of changes, so we're lifting that China weight to a neutral. We're also adding some quality stocks in Mexico, and we've trimmed some of the cyclicality in India, although we remain overweight there. And also we're going to talk, I'm going to dig into a little bit more into Indonesia and Taiwan later, but making some trims there and just allocating to more quality defensive stocks. Okay, so just running through attribution quickly here, I think the things that will stand out, we're talking about, so you can obviously see China at the top there, and Hong Kong, so it's been a drag for the fund. So we're a little bit underweight there, but as I say, we're doing that gradually. Moving down, we can also see some negative contribution from Taiwan, so those consumer cyclical technology stocks are drawing down as we can see data coming through on global consumer weakness. So that's, you can think about that like, so mobile handsets. And again, so you can see countries like South Africa, Brazil contributing there as materials draw down. So we're underweight to those sectors. So it's much the same here in sector attribution. I think the one thing that one of the things that stick out are those more cyclical areas of the market are drawing down, except for consumer discretionary. So you can actually see sort of portfolio returns there positive, and that sector's been up for the month, and that's mainly driven by Chinese mega cap tech stocks. And so just moving along here to security attribution. So I'll dig down into this a little bit more. So I'd split the contributors up, and it's mainly, as you can see here, China, and that's across sectors, as we've seen easing regulatory headwinds, macro recovery, and an improving liquidity environment. So you're seeing price rises across IT, across materials, and also financials. So AIA, Pan-Asian insurer, they're very high quality business. And so again, in terms of the detractors here, we can see those more cyclical businesses that are, so like Wizz Air, for instance, obviously nearly half through the month, really struggling there. So we're going to be reviewing that investment case. And then also China Merchants Bank is a bit of an idiosyncratic case there. We've got a corruption allegation against the ex-chairman. So while that is a personal investigation, we're not comfortable with the level of political risk, and we've moved that out of the portfolio. So onto the top transactions here. So I would split it up as adding to quality. So you can see names like Walmart Mexico, so very high quality defensive with low leverage and very steady growth. In this sort of environment, when liquidity is draining out of the system, we're going to favor those stocks with very high and stable ROIC. And so Walmart fits into that box. Taiwan, so CTBC Financial Holdings is in a similar vein. And so we've allocated to that, taking money out of China Merchants Bank, moving that into CTBC. And then you can also see China there, adding to that China allocation. And again, I would split that up. So JD.com is that quality growth defensive. So those high quality tech names that are already growing businesses have robust balance sheets, and they're coming out and enjoying easing regulatory headwinds on the e-commerce space. So all the big beasts in China are coming out and announcing that they're going to take it a little bit easier on the tech stocks, and that's been a big headwind for those stocks. But I think more interestingly for us, so NIO and XPeng, these are Chinese EV companies. So NIO is more in the luxury segment, XPeng is in the affordable segment, and these we think are the big structural winners that can compete on a continental sized market and then go out as they build scale and dominate globally. So in terms of sells, I've mentioned a few of these already, but I think the big ones that stick out that I'd like to draw your attention to in Thailand, so PTT Exploration and Production. So that is one that's done very well. We're happy to sort of trim across Southeast Asia, some of the stocks that have done really well there, and free that up to allocate to more defensives elsewhere, and also to top up on our China weighting as well. So Naver Corp, it's internet stock in Korea. So it's one of these long duration names, which I would say has been the speculation of choice for the last few years. And it's one of the types of stocks that we see is a little bit more vulnerable in an environment of contracting liquidity. So jumping on quickly to country allocation here, you can see us. So if you add China and Hong Kong together, that's a neutral weight there in China. We're going to be gradually bringing that up, bringing ideas into the portfolio, and as I say, both to defensive, high quality, and structural winners there too. Just within the interest of time, I'm just conscious we want to leave plenty of time for questions as well. So South Korea and Taiwan, then you can see both underweights now. We're trying to reduce that exposure to consumer cyclicals as we see data of consumer weakness globally. Gulf markets there is obviously a big standout underweight there. The team has been now debating as to whether we want to lift that weight if we want some more high quality energy exposure in those markets or something like an LRG. Those stocks have actually come down about 30% over the last few months. So there is a discussion happening now in the team as to whether we want to lift some exposure there. Sector allocation is continuing a lot of the same themes. I'm not going to comment on these at the moment, just in the interest of time. Now, moving on to outlook. So clearly we've been really banging the table about a contraction in liquidity. And so what we talk about is excess money supply and what that does to markets. So obviously in 2020, we've got a massive ramp up in liquidity ahead of economic growth, and that's going to flow into markets, creating a bull market somewhere. So what we now is we're having the inverse of that now. So liquidity contracting quite dramatically. Economy is starting to slow, but it's still growing. And so we're now seeing bear markets all over the place, including in emerging markets. However, we're starting to see some signs of consumer weakness and some evidence that we may have already reached a peak in inflation, or it might be sort of on the horizon already. So that is one of the big factors for us that we're keeping an eye on with respect to how we should be constructing our exposure in this environment. So moving on to emerging markets, and in particular China. So you can actually see that liquidity drain from US and China. So real narrow money falling below the zero line, so negative growth. Whereas China, it really stands out there, is sitting above the line. We've got growing liquidity. And so we've seen that pick up in markets as well. And there are a host of other factors, though, some positive macro data coming through, regulatory headwinds easing. And on the right-hand side, we can see the outperformance by China over the last few months, bottoming in March as one investment bank declared it uninvestable. So that immediately piqued our interest. And so the data there is continuing to improve, and our method and our process is to continuously factor that data in and adjust the forecasts and also the portfolio weightings accordingly. It's very much an incremental process. So now, looking at Chinese broad and narrow money, the only comment I'd make here is that we were looking for evidence of true M1, so the narrow money picking up, which means money circulating in the system rather than sitting in people's savings accounts, which is the M2. So we're actually seeing evidence of that now. So I think it's another bullish signal for us. And for those people who have questions maybe about the Chinese housing market, at the moment, it's quite a positive liquidity environment, and house prices actually at the moment are quite stable, but it's definitely something that we're keeping an eye on. And just lastly here, we're seeing broader emerging markets and liquidity in emerging markets. And I'd say if you line this up next to developed markets, it's a much more positive picture. And I think that actually plays into why EMs have held up in part, performance-wise, even though it's down month, but it is outperforming developed markets. Emerging markets were under-owned, came into this with less leverage, having not been able to stimulate through COVID. So balance sheets were actually healthier, and central banks in a lot of emerging markets have a far greater tendency to fight inflation and raise interest rates and be aggressive to try and crush inflation early. So I think there are for some emerging markets, I think, are really appealing, and broadly, I think the liquidity environment it's not ideal, but it is, I think, in relative terms to DM, I think it's fairly positive. And then on the right side, you can see the relative valuations versus developed markets. I think it's very compelling. It's the widest spread in terms of valuation it's been for the last 20 years. As far as when that reverses or when the dollar comes down, I mean, it's hard to say, but we think that the case for EM is well and truly there. And if we do sort of move into a recessionary period and valuations get even more compelling, I think it's a very interesting time to be adding to EM. Thanks very much, Neil. free to take questions.
Great. Thanks very much, Mike. Always enjoy listening to you and chatting to you. I guess we have time for one question. So it's pretty much about your country overweight. So in absolute terms, Indonesia and Thailand are kind of two of your biggest country overweights. And what would you say, is attractive about these countries to you and your team, please?
So from a macro level, what we like is positive exposure to rising rates and also to rising energy prices. So a company like PTT Exploration and Production is nicely levered to rising oil prices. It's a high quality oil company that you'd find in most of emerging markets. So that's something that's really attractive, especially when you have Russia rolling out of the index as it has, and that's where a lot of investors have been going to get that higher quality energy exposure. But elsewhere, there are companies like Bank Negara Indonesia, which had positive exposure to both oil and rising rates. So that was another, I think, definite positive exposure to the current economic environment. Plus, all of these economies are benefiting from a reopening. So Thailand, tourism is starting to open back up. I mean, if China does release an mRNA vaccine and they're able to get on top of COVID, you're going to see a flood of tourism into places like Thailand. So we like exposure to all these factors, but I would say that this region's already done very well. So we've been overweight for some time, and we're now using it as a source of cash to reallocate to China. So, and I think one point is we really, really love the region, but it's also a question of our macro data may say that this region is positively predisposed to the things that are going on economically and in terms of liquidity, but it's also a matter of finding the right stocks. That's what we need. We need to have the right stocks. So those markets aren't necessarily anywhere near as deep as a place like India or as China. So we are a little bit limited into how much we can actually lift the exposure. If it was a deeper, more liquid market, you'd probably see more of an exposure to these regions. But it has been a very good place for us. But at the same time, I think what's exciting about it is it provides a nice source of cash for some of what I think are some of the areas that are going to outperform even more starkly in the sort of short to medium term.
Okay, brilliant, Mike. Thanks very much for your time. Look forward to seeing you next time, and all the best to you and the team.
Thanks very much, Neil. Thanks very much, everyone, for having me. Bye.